Well, hello, I'm Scott Hansen,
I'm Pat McLean.
and we're with Allworth. This is our Money Matters brief, where we come periodically just to chat about what's happening, our new world we're in with coronavirus and our shelter in place and what this means for the economy and whatnot. We thought we'd take a few moments to be here with Andy Stout. Andy's our Chief Investment Officer. Andy is working out of his home office you're in Cincinnati, is that right, Andy?
Cincinnati, Ohio,
All
but
right.
like everybody else, from my house.
That's right. So we thought we'd spend a few moments with Andy to talk a little bit about the economy and the impact that might have on the financial markets, stock markets, bond markets, et cetera. So, Andy, why don't you give us an update of the kind of the latest? We're recording this on April the 15th.
And Andy, can you take a couple minutes and actually talk about the banking and financial services sector and how they're doing relative to the last recession? Because last recession it was all about the banks. Um, Give us your view, compare and contrast, as well as, let's say, retail sales and the overall economy, please.
Yeah, let's start with the banks. So we're actually at the beginning of earnings season, which isn't really much earnings right now. But what we're watching in this first week is we're getting a lot of reports from banks themselves. And we all know earnings aren't going to be great, but what we're really looking at is the loan loss provisions. How much money are banks setting aside to essentially weather the storm as you look at the potential for other companies to default on their loans? Now, this would make you think that, okay, there's a lot of risks here for banks. But compared to the 2008 Great Recession, banks are very well capitalized. So we don't really have the risk of financial Armageddon. So we certainly have a very bad recession we're in the midst of, but it's really different. I mean, it's a lot different from what we had in 2008 when we didn't know if the banks that you're using were going to be open from one day to the next. So when we think about that, it's a different beast altogether. So today we get the retail sales number for the month of March, and this was really in the midst of the shelter in place is going into effect. The April data will probably be worse than what March was, but what we saw was a negative 8.7% drop in retail sales for March compared to February. And the data starts to 92, and this was the worst on record. So
And
this certainly.
I was thought it'd be worse than that. I mean, I think of my own spending, it's like almost non-existent. I mean, other than food,
Yeah,
You're still
no
going to the grocery
entertainment.
store. Yeah.
yeah, but it's kind of a paradox because those that are people that are fully employed at the same income are actually probably have the highest savings rates ever. Because they're only buying what they need, not what they want. It's a strange world.
Yeah, and what you had, I mean, if you think about like the different income levels, people in the upper half, roughly speaking, they're going to be your more savers. It's the bottom half as far as the income, where they essentially spend everything they have. So if there's a lot of people being forced to stay from home, there is some forced savings from that perspective. Now the question is, how long can they maintain at that level without a job? Now, fortunately, there is some sort of government support for those. But when we think about the retail sales in general and how it relates to the overall economy, yeah, Scott, you're right. It could have been worse. But quite frankly, I think no one has any real good idea of what this is going to be. These are really a bunch of spitball estimates out there. When we think about the data, I mean, right now it's looking like the first quarter will probably see a contraction. Economists are around negative 3%, but it's that second quarter. That's the one that's going to be bad. But here's the thing. Don't freak out when you see the headline number. You're going to see a negative 25, negative 30% GDP. Now that's
Wow. Is
annualized,
that
so
kind of a
that's not.
general consensus right now? I mean,
Right
it's
now it
interesting. You look
is.
at economists and they're all over the board. Some are not that pessimistic. Others like dire warnings. I mean,
Yeah, it is. It's kind of in that area. So you're going to see that headline. Now that headline won't really come out till the end of June. I mean, that's when we'll get, or the end of July, excuse me. That's when we'll get that estimate for the second quarter GDP. But when it comes out, it's going to scare a lot of people. But keep in mind, stock market's not the economy. The stock market usually looks forward about 4 months on average to an economic recovery. So that's really the key. When do we start to rebound from this? I mean, right now, it's expected that we do have positive economic growth in the third quarter and fourth quarter, but we all know that's really going to depend on how the medical field does in essentially fighting the coronavirus.
Hey, Andy, let me ask you a question. So this time versus the last recession, 08, 09, I think that the federal government, Treasury, and the Federal Reserve did such a great, I hate to say this, they did a great job in the bond market providing liquidity almost immediately. something that we didn't see the last time around. Do you think that they'll continue to provide liquidity in the marketplace, and do you think that bodes well for corporate America and portfolios as a whole?
No, they have no choice but to provide this liquidity, because when they weren't providing liquidity, when it became clear that we were having this sudden economic stop and things were going to slow down, you saw just trading freeze up, and that
Okay,
has
and
ripple effects.
excuse me, for the listeners, will you describe what liquidity means? And when you and I are having this conversation in English, what are we saying?
So if you're a large mutual fund manager trading bonds, maybe you need to raise some cash for whatever reason. You go out there to sell what would normally be a very highly rated bond. Could be like a AAA rated corporate bond, or even a AA. That's like AAA is the highest rating, then AA. So things that are very solid, very financially sound, and no one wants to buy it. Well, then all of a sudden, if no one wants to buy that, that has a ripple effect on prices of other bonds. So what the Federal Reserve has done now, a lot quicker, Pat, you're right, because they didn't really get involved to much degree until November of 2008. That's really when they stepped in. They stepped in right away. Part of the problem was in 2008, they had no playbook. They have a playbook now. They went straight to the very end of the book and did everything immediately. And now Chair Powell is writing some new chapters, and I wasn't very complimentary of Powell last year. I thought they made quite a few mistakes. But this year, I mean, he's done a pretty good job in leading the Fed. So I think, I really do believe that they're doing a better job overall, and I don't think they're going to go anywhere. But from the fiscal side of things, so what Congress is doing, they did a lot to start with. I think more needs to be done.
So, kind of wrap it up because we only have another minute or two. On the backside of this, would we expect to see inflation? Would we expect to see higher tax rates? Would we expect to see a change in the healthcare system? I guess that's a little bit more political, but you see it out there right now. You see agendas being driven through this political process, which quite frankly, at times, I think it's not the appropriate time to drive your agenda. It's to fix the problem. So your comments on that, please.
I think you might see a little bit of inflation, but I'm actually not too worried about inflation. There's some bigger picture effects out there, like demographics, that are going to keep it contained to a degree. And there's also the big question of how much bankruptcies do we have during this recession? What the government's trying to do is keep these small businesses open so people have jobs to go back to. If they don't have jobs to go back to, that's certainly going to make it less likely that you do see some sort of inflation.
Let me ask you this, Andy. So I know some people are thinking economic markets are horrible. We were just talking about the lack of liquidity in the bond markets. Like, why don't I just take everything and stick it in cash, stick it under my mattress, wait till this thing blows over, and then look at investment opportunities?
Well, on the stock side, we already talked about that, but that's where the stock market does move before the broad economy. So yeah, if you're just watching the economy, you're going to run for the hills and hide. Now, I would be surprised if we don't see more volatility. I mean, it's likely, but I'd be more surprised if we look a year out from now that we don't actually have higher prices in stocks from where we are today. On the bond side, what another thing the Federal Reserve is doing, we talked about the providing liquidity, they're essentially going out there and buying corporate bonds. They're buying other types of bonds. So what you're seeing a lot of fund managers do is follow the Fed. It's a very popular strategy right now, because if the Fed's buying things, you know what these fund managers do, they're going to front run the Fed, they're going to buy the Fed, and they're going to possibly see some positive returns on their bond investments.
Yeah, I mean, I think if we look during the financial Great Recession, those that did that strategy, by the time it's not like the green lights ever come back on. It's like, now's the time to buy. It's only after prices are run way back up.
And if you had missed last week, what would you have missed?
Oh, well, right? Well, last week you saw a 13% rise in the broad stock market. So it was a pretty good week last week. But we're going to see more ups and downs, and trying to know when that exact bottom is, that's only known in hindsight. But here's one thing you do know. If you look back at the prior bear market bottoms, 1 year from that final low, the broad stock market, using large cap stocks, was up 43% over the next year. So if you're able to know exactly when the final bottom is in, more power to you, but I would venture to say that's almost impossible to know. That's why you focus on the long run and keep and stay invested.
Andy, what are you paying attention to mostly right now on a daily basis? Like what? Yeah, I mean, because it's a different world right now. This is an external factor that wasn't in anyone's model, a global pandemic. Right. So what is it you're mostly paying attention to?
Yeah, I mean, to your point, the traditional economic data that you'd be watching, it's pretty meaningless right now. I mean, the economy and everything's moved, and the data is going to be catching up to where we are. So, I am watching some economic data, some of the more like high frequency ones, like jobless claims, looking for eventually seeing a leveling off of the jobless claims, the weekly jobless claims. Consumer confidence is also a pretty real-time measure. Would like to see some improvement there. I don't expect any improvement, let's be clear, for quite some time. But as far as, related to the coronavirus, I'm watching the new daily cases, new daily deaths, and what we have seen a flattening curve here in the U.S. I mean, that is evident. We're seeing the new cases today, or as of yesterday, were essentially the same as they were on April 2nd. So they went up a little bit going after April 2nd, and now they've come down, and we're basically back at that level. But what I'm also watching these models you're seeing quoted on TV, so like University of Washington probably is the most widely cited model, and looking at what their projections are. And as far as like they project like the number of new beds needed, ICU beds needed, ventilators needed. And when you look at this over in time from May 1st to June 1st, I mean, you're seeing it drop pretty steadily. And by June 1st, there's really not much ICU beds, not many ventilators needed. And the daily deaths at that point, they're projecting about 100. So I mean, there's obviously some margin within that, but they're projecting about 100. So I'm watching that data, because once you see that start to curve, that's going to lead to the reopening of the economy, and that's where you're going to see the improvement in corporate profits going forward. So I mean, that's just one thing. I know Germany, I just saw this headline across the wire here a second ago. They're actually going to reopen schools here in May. So they're moving to that degree already. So that was a little bit surprising from that, but it's a good surprise.
All right. Well, Andy, thank you so much for your time. We'd love to come back and have this conversation. I thought the most interesting part was the last minute or so, when you said that the reports and the things you used to look at were irrelevant today. There's a whole new list of things that you actually have to examine in order to put the investment thesis together, right? Which is it's fascinating.
It's a new world. Well, yeah, Andy, thank you very much. Again, Andy Stout, Chief Investment Officer of Allworth. Greatly appreciate your time being with us. And you've been listening to Allworth's Money Matters Brief. Have a great week.
Stay safe.